management. NCDX IPF Trust is organizing this event in association with CLEFMA. The objective of this event is to basically create awareness and education on the importance of the derivative markets and how one can manage your price risk. Given the recent volatilities, the importance of price risk management has taken importance in the industry. And to give you an understanding of what exactly price risk management is, hedging is, and how it has to be done, NCDX IPF Trust is organizing these classroom series. And as the name suggests, it's a classroom series. This will be a uh, uh, three weekend series. We'll be organizing these series on every Saturday for 2 hours from 10 to 12 p.m. So today's classroom series is the first of the series, and today we have Dr. Neeti Nandini Chetnani with us, who is going to start the session for today. She is a professor of finance in the Indian Institute of Foreign Trade, New Delhi. A very warm welcome to you, ma'am. Thank you for taking your time out and participating in our series today. To give you a brief about Dr. Neeti, she's a professor of finance at the Indian Institute of Foreign Trade, New Delhi. She teaches courses on corporate finance, investment management, derivatives, and commodity markets. She is also the head of the alumni affairs at IIFT. Her PhD has been in the area of microfinance for women's empowerment in India. She has more than 25 years of teaching experience at the MBA and executive MBA levels in business schools, and has authorized several research papers, case studies, and a popular book titled Commodity Markets and Derivatives. Her second book on financial literacy is in the publishing pipeline. She has also attended the Global Colloquium on Participant Centered Learning at the Harvard Business School in 2011-12. Dr. Chetnani was awarded as the best teacher in financial management in 2015 by Lokmat National Education Leadership Awards. She is also acknowledged by CBSE as an ideator for the CBSE I curriculum in 2014. Dr. Chetnani has also supervised several PhD students and serves as an editorial member for various journals, as a PhD evaluator, and as a visiting faculty in many prestigious B schools. She is passionate about using her skills as an educator to share knowledge and is particularly focused on serving the underprivileged sections. Her other passions include working to support education for all, promoting financial literacy among youth, conserving the environment, and traveling. We once again welcome you, ma'am, for this session, a classroom series on prices management. I'm sure the participants will gain a lot of understanding or knowledge of what these markets are, derivative markets, and how they can use these. Over to you, ma'am. Thank you so much.
Thank you, Bhupalini, and welcome to all the participants. So please confirm that you can hear me. Can you all hear me?
Yes, ma'am.
Right. So, when I was approached by NCDEX to do this session in their classroom series for price management, and told that this was for in collaboration with CLIFA value chain participants, I began by doing a lot of research on what really are the issues being faced by the soya value chain participants. And please tell me if you agree with me as I progress, because this is the understanding I have developed about the soybean sector, which is that there has been an increase in soybean prices over the last 1 year, a very sharp increase, or over the last 6 months, the increase in sharper. And this has been for feed manufacturers, because that has also led to soya meal becoming more expensive. And the CLIFMA and other members who are associated with the soybean sector have been approaching the government to take steps to help them in the face of this sharp and unexpected price rise in soya meal prices. And so some of the things they've been requesting for are to allow imports of soya meal, to keep a check on any kind of hoarding or speculating activity that might be taking place on or off the exchanges, and to generally take action that is that where we all coming from? You can put in the chat box or you can unmute and speak. Are we all on the same page with regards to this understanding? Would anyone like to say anything? Sandeep, Sandeep says yes. Also, what I've understood is that there is a group of people who have an understanding of what leads to movements in soybean prices, feel that it's factors of demand and supply which is leading to this price increase. And another group of people who feel more than fundamental side as well as change in the future to this. So there are two schools of thoughts here. And in any case, the expect
Neeti ma'am, 1 second. Can I
from
just
the
stop
girl,
you there? And hello,
yes,
hello.
yes, please.
Yes, ma'am. Ma'am, I think your voice is breaking. If you can just turn off your video, probably, because your voice is continuously breaking in between. Probably that will,
Yes,
yeah,
I've done that.
please. Yeah, thank
Now is my voice
yeah.
better?
Yes, ma'am. Actually, it was continuously cracking in between.
No, it may have been cracking because of the signal from my phone.
Yeah. Okay, okay. Yeah. Now you can continue, ma'am. Thank you.
Yes. So it's Bhupalini, please let me know if at any point my voice is not clear enough.
Sure,
So
ma'am. I'll do that. Yeah.
yes. So I was saying that there are two groups on with views on why prices have been rising. There's one group of people who say it is fundamental factors, demand and supply. So because supply is falling short of demand, which is unexpected demand coming for soya meal and soybean, of course, post the pandemic, and also shortages in supply because of drought in Brazil and issues in Argentina, which are the biggest suppliers of soybean to the world, and these are leading to price increases. The other school of thought says, no, this is because of speculation of the exchange as well as in futures contracts on the exchange. So there are two groups of thoughts, and that is very common. Whenever there are price increases or price volatilities witnessed in the prices of any commodity, then there will be always two opinions on it, whether it is fundamental factors leading to this or whether it is speculation on the commodity off and on the exchanges. When when soya value chain participants and various associations like CLIFMA or SOPA or whoever expect the government to intervene and bring a check on prices by way of allowing imports of soya meal or by way of a crackdown on hoarders or by way of checking speculation on the exchanges. What they're actually expecting is a policy-based, non-market-based way of okay, are they expecting that the risks they are exposed to because of the sharp rises in the commodity prices will be managed through policy-based measures rather than through market-based measures? In this case, when you expect policy to be directed towards controlling prices, you're depending on an external agency, the government in this case, to stand up and take measures to bring a kind of a cooling down of prices, which may or may not happen, which may happen partially, which may not happen to everybody's expectations. So that is one way of managing price risk. What I'm going to talk to you about today specifically is managing price risk that you are exposed to as a soya value chain participant using market-based instruments, which is derivative contracts. You use market-based instruments uh, to control your price risk, to manage your price risk. And so our focus is going to be on this understanding today. So with this much of a background, I am proceeding with my uh, session today. Right now, the objectives of the session, I hope to cover this in 2 hours, is introduction to the concept of risk, hedging, and price risk management for soya value chain participants. I am not going to spend too much time on that. A discussion on the significance and elements of a well-articulated hedging policy. So for those of you who may be stepping into hedging for the very first time, or who may already have hedged, in their own way initially before coming to the session, I must tell you that hedging policy is very, very helpful for defining your hedging framework. And so we're going to do some discussion on that, outlining the steps necessary to implement an effective risk management program, a discussion on price risk management in managing the budgets or your profit margins, and then understanding basis risk. And so I'm going to spend, this is, a description of the amount of time I'm going to tentatively take on each topic, but depending on how, you want this session to proceed, we can change the time discussion. I'm not very sure, when I take a class, I'm pretty sure of the understanding of the students. So some of you here may be already quite familiar with how derivatives are used for risk management. And so, and you can always let me know if that is the common thing across all participants. If something looks too elementary to you and you want me to move on to the next topic and discuss it in more depth rather than, talk about things that you already know, please let me know by writing so in the chat. Now, it goes without saying that, when any kind of economic activity that you undertake, risk will be a part of it. And especially when you take up an entrepreneurship thing, when you step into business, risk is something that you embrace voluntarily. And with the growth and interconnectivity and the complexity of the world economy, one thing is for sure, the dimensions of risk have increased, not decreased in any way, but also the opportunities to manage that risk have increased. So it's both ways. It's a two-way, interconnectivity of the economy is a double-edged sword. Your risks increase, but so does your ability to manage those risks. So for a business, it is very important to understand what are the kinds of risks that affect them. So assess what is the existence of each kind of risk. In this case, we're talking about price risk. How big is it for you? What is its quantum? Is it a small risk? So, for example, if you are, a very diversified entity, you don't just use soya meal to make a feed for animal feed or poultry feed. You also use, various other kinds of meals to do this, and maybe soya meal is just about 15 to 20% of your raw material, then probably its quantum is much smaller. But if soya meal is 75 to 80% of your raw material, then the quantum of risk is higher, right? Sometimes the quantum of risk is affected by how volatile the prices of a commodity are. And then you have to understand its impact on your business, on how a 10% increase or a 10% decrease in the prices can affect your profit margins. How sensitive are your profit margins to changes in prices? And then finally build mechanisms to mitigate the unwanted part of that risk. So that is possible by using market-based instruments. Now, there are, when you try to sit down and kind of list down the kinds of risks that your business faces, you will find that you can categorize risk into many categories, but I'm talking about three primary categories. which can be managed through hedging in various ways. Market risk, which includes price risk, which is a risk that is taking place outside of your business, in the business environment, and which is a risk which is outside your control, but you can certainly take steps to manage that. So price risk is one kind of market risk. Credit risk is when you have a loss because a counterparty is defaulting or delaying your payment. And then you can have operational risk, which is risk because the operations of your business are not robust enough. They're exposed to risk. So there are ways manage each kind of risk. We are focusing on managing price risk, which is a part of market risk. Now here is what basically to understand it myself and also to set the tone for today's discussion. This is the movement in soybean spot prices taken from Indore market from 1st of July 2020 to around 4th or 5th of August, last 1 year almost. Okay, so you can see that if you were to do a trend here, you can see that the prices have risen. Risen very sharply over the last 5 to 6 months. The rise has been extremely sharp, right? So the minimum price during this period of 1 year was per quintal was on 1st July 2020. It was 3704, and no, the minimum price during this period was 3704 per quintal, and the maximum price, of course, it crossed 10,000. So that's like more, almost or more than a threefold increase. And the average daily price change, day-to-day price change during this period was almost close to 0.4%, or almost close to 0.5%, with a standard deviation of 1.6% daily price changes, which is quite a bit. Day-to-day price changes. So this kind of a price, volatility, if you've seen, or I mean, what you're seeing is an increase in prices along with volatility has conveyed or translated into a risk for both buyers and sellers. But when the prices are rising, it's the sellers who are happy. It's the buyers who are exposed to the risk of having to buy each time at higher and higher prices. So this is about the Indian prices if we benchmark it with the Indore market. If you look at the prices of soybean in the in the international market, so I'm taking the prices from CBOT, and these prices are in, of course, they're not in rupees per quintal, they are in US dollars per bushel. But the trend is there for you to see. So there has been during this time a similar kind of a rise and volatility in soybean prices, except that over the last 1 month, the price has not been rising the way it has been rising in India. And that is because of the Indian soybean is slightly higher in terms of global prices because of an existing supply deficit. So yes, the prices in India have been on the rise despite the global prices not showing the same kind of a rise. But I believe, now please let me know once again whether this is right, that the government has allowed imports of soya meal, some imports of soya meal, and with that news, the prices have cooled down. Is that correct? Imports have been allowed and prices have come down. Someone would like to respond to that? Now, so, okay, now coming back to commodity price risk, volatility price step. And like I said at the very beginning, the volatility can make your profit margins very, very unpredictable, or it can wipe out your profitability if it is one-sided volatility. If you're a buyer and prices are continuously on the rise, it can wipe out the profitability. And if you're a seller and prices are continuously on a fall, it can wipe out your profitability. But if prices are volatile, then the profitability becomes very, very unpredictable. And perhaps the most important requirement for a business is predictable profit margins. Now, businesses and governments have used a lot of policy-based instruments to support to mitigate the risks of commodity volatility, allowing imports or crack down on holders, policy-based instruments. But we are going to talk about market-based instruments, and we're going to talk about hedging. So hedging serves two important objectives. Why hedging? Because there are two important objectives it serves. One is it's like an insurance against commodity price volatility. So they can, when you have hedged, you are kind of insured against any ups and downs in the market prices of the commodity that you're buying or selling. And so that is one part of it. That is, on a day-to-day basis, you are kind of immune or insulated against the volatilities in commodity prices, which otherwise could have been extremely damaging to your profitability. Now, the second thing, which many of us tend to overlook, is a long-term view of what hedging does for a business. In the long term, hedging is a very important strategic initiative for a business to put in place. Why? Because it lowers a business's tax liability. Now, this is a very economic rationale for doing this. When you are faced with a tax structure, which is, the kind of slabbing that we have, or a convex tax structure where as your incomes go on rising, the tax structure becomes more and more steep, then losses don't save you as much taxes as profits lead you to paying more taxes. Okay, so if you are hedged and you don't have expected profits or unexpected losses in your business, then your tax liability overall is lower, because when you have more stable profits, when you have more predictable profits, your ability to raise capital, whether in the form of debt or from the markets in the form of equity, increases. And it has a positive impact on your corporate governance. Again, a very economic reasoning here, but the agencies, some of you may understand that the agency differences between the investors or the shareholders and the managers of a firm may come down. Now, it's this corporate governance is a big issue for listed companies, not such a big issue for smaller businesses which are still not listed. Now, while I'm going to talk to you about using derivatives for hedging, I wanted to tell you that there can be also a lot of other off-market methods for overcoming the undesirable impacts of commodity price volatility. You could get into long-term purchase and sale contracts. You could get into backward or forward integration. You could get into, alternative inputs as a commodity. You could go for diversification. I'm just going to discuss all of these with you. When do you choose which method of price risk management, and when is it that hedging becomes the important price risk method for you to follow? So the hedging that we're going to discuss, or it's also called financial hedging, because you're using contracts or derivative contracts listed on an exchange to manage your price risk, is a market-based approach to price risk management. It uses derivative instruments, 4 types of derivative instruments: forwards, futures, options, and swaps, to set up very cost-effective and very effective in delivering their objective price risk management strategies. Please tell me at this point, are you aware of the various types of derivative contracts? Do you know? Do you know the types of derivative contracts that I've just talked about? Forwards, futures, options, and swaps. Do you know about them? The differences between them. What are the advantages and disadvantages of using each contract? Are you aware about it, or would you like me to discuss for some time on these types of derivative contracts? Can someone unmute and Neeti knows. Tanya says, please discuss. Anyone else? I will be happy to discuss. That's not a problem at all. But I just want to know what is the common, what do of the participants 23 that we have here, what is the general thing? Do you know what are the types of derivatives? Shall I proceed with a discussion on the various types of derivatives? Please discuss the types. Okay. So let me just tell you that we have 4 kinds of derivative contracts: forwards, futures, options, and swaps. Okay. Now, first of all, what is a derivative instrument? What is a derivative? A derivative is actually not the asset itself, not the commodity itself. You're not buying or selling the commodity. It's an agreement or a contract to buy or sell the commodity, any asset it could be, but in our case, it's the commodity for a fixed price. The price is fixed today, but the transaction will be done at a later date. So that's a derivative. So today you enter into a contract where you fix your price to buy or sell something at a later date at that fixed price. So now you lock in a price for a future trade, and later on, the date for which you have agreed to do that trade, you actually pay the money as a buyer, receive the commodity, or supply the commodity as a seller, receive the money, and complete the contract. So that's a derivative contract. Now, the whole idea of a derivative contract is when there is price volatility, you are insured against that price volatility by having entered into a derivative contract and locked in your price to buy or sell at a later date. So whether prices increase or decrease, your buying or selling price is fixed for you today, and the transaction will be done at a later date. So what you're doing today is you're entering into a contract. Because these are derivatives, you are entering into a contract by fixing for commodities. You're fixing the quality, the quantity, the location on which delivery will be given by the seller and taken by the buyer, the date on which this transaction will be done, and the price at which this transaction will be done. So you're fixing all this. So there are actually 5 parameters. If you see here: quality, quantity, delivery location, delivery date, and price. The 5 parameters are fixed in the contract today, but the contract is finally executed at a later date. So later date, the contract is executed as per the contract terms. So you complete the contracted trade, the trade that you contracted in the past, either through cash settlement or through physical settlement. Now, this is important for you to understand. You can enter into a contract with your seller, or if you're a buyer, you can enter into a contract with your seller in a very, without involving an exchange in between. So forget about the existence of an exchange or the need to go to an exchange. The buyer and the seller enter into a contract with each other to buy or sell these quality, quantity, location, date, and price for future date. Or you could have a series of future dates. So you could say to your seller that I'll buy from you every 15 days. I'll buy stock for every 15 days. I will buy stock for every week. And the prices are fixed for each transaction. Then the seller will deliver the stock to your desired location. That's called a physical settlement. A physical settlement is when the seller delivers the commodity and the buyer makes the payment for it. However, if you're doing a similar contract between the buyer and the seller, but this time you're using an exchange to help you enter into a contract, you're using an exchange as the intermediary, in which case the exchange is designing the contract for you and saying this is the contract that you can negotiate. So what the exchange does is the exchange fixes the quality, the quantity, the delivery location, and the delivery date in the contract. The only thing that you can negotiate is the price, and even the price is negotiated at levels which are close to the prices at which the contract is trading on the exchange. If you're doing an exchange enabled contract or using an exchange traded contract, then you also have the opportunity to cash settlement. What is cash settlement? Rather than saying that the seller will give me the commodity and I will make the payment as the buyer, you say, look, if today we've agreed for a price of 8,000 rupees per quintal, and when the contract date comes, if the price is something like 9,000 rupees per quintal, then it is something like this. Let me show you so this is the price that has been agreed, right? 8,000 rupees per quintal. If going forward, the price moves to 9,000 rupees a quintal, then the buyer has profited, right? The buyer has been able to negotiate this contract at 8,000 in the past. Today the price is 9,000. So the buyer has a profit of 1,000 rupees per quintal. And the seller, who could have sold today at 9,000, has a loss of 1,000 rupees per quintal. So the seller will pay 1,000 rupees to the buyer, cash settlement. But if the prices have fallen to say 7,000 rupees a quintal, then the buyer is stuck with the price of 8,000 and the seller has a price of 8,000 kind of fixed for him, in which case the seller will have a profit and the buyer will have a loss, and then the buyer will pay 1,000 rupees per quintal to the seller. Now, if you look at the NCDX contract, okay, so you can let me try to okay, or let me just tell you that you can look at the NCDX contract for soybean, for example. The exchange traded soybean futures contract is for 5 tons. So the quantity has been fixed at 5 tons. Okay, you cannot buy or sell 3 tons or 4 tons or 6 tons. The quantity is fixed for 5 tons. You can buy 5 tons or multiples of 5 tons through each contract, or sell 5. You can either buy or sell through that contract. The quality is also fixed in that contract, and you can look at the contract specifications, which I can share with you or Bhupalini can share with you for you to understand. So the quantity is fixed, the quality is fixed, the delivery location is fixed as Indore or Latur and a few other delivery locations where you can take delivery or give delivery, and the dates are fixed. So the dates are, the contract expires on the 20th of every month. So 20th of August and 20th of September, whatever. So the contract expires on the 20th of every month. And so you have to fine tune your accommodate those fixed small specifications of the contract. It's for 5 tons. It's for a specific quality which may be close to or slightly different from the quality that you're interested in buying or selling. It is to be delivered only on a handful of locations, and it is only deliverable on it is only a contract for the 20th of every month. You may want to enter into a contract for the 1st of the month or for the 5th of the month. That will not be feasible through an exchange traded contract, because it has its own it has its own specifications. In other words, it's standardized. So let me just give you a broad understanding of the various kinds of derivative contracts, or if you like, you can call them derivative instruments that are there. Forwards are where you don't involve an exchange in between. They're over the counter or bilaterally negotiated between the buyer and the seller. So you may be a soybean buyer or soya meal buyer. There may be a soya meal trader who's the seller. So you enter into a contract with a trader saying, I'll buy X quantity of soya meal from you every Friday or every alternate Friday or whatever day is convenient to you for the next 6 months. So let's fix a price for it. So it is over the counter, in which case you can customize the terms of the contract. All the 5 features or parameters of the contract, you can design as per your requirements. You can tell the trader, I want so much quantity, this specific quality to be delivered on this specific location on these dates for the prices that we can both agree. So the terms of the contract can be customized, but there is no, no involvement of a third party in between. So there is no clearing of the contract in the sense, no one is standing guarantee that there will be no counterparty risk, that the trader of soya meal will not, will not default on supplying soya meal to you if the price of soya meal go way above the price that the trader has agreed to sell to you at. If that happens, that the trader defaults, there is no really no remedy in a way for this, right? So there is no clearing or no margins involved, which is what happens if you execute the trade through the exchange. There's no risk to you because the exchanges systems or processes for clearing are so strong that no one can really default. So these are the features, and the disadvantages are that the markets are opaque. You really can't, there is really not much information available on what kind of trades are being negotiated in the OTC markets, the opaque markets. They're not reported in the public domain. The contracts are illiquid in the sense that if you enter this contract, a forward contract as a buyer or a seller, then it is almost confirm that you will have to settle the contract through physical delivery. You cannot sell the contract to someone else saying that I had a contract to buy so much soya meal from this trader on these dates at this price, but now I don't want it, you take it. That is not possible. So you are kind of stuck with the contract once you enter into it. And there is counterparty risk because there is no exchange involved in between. The risk of default on the part of the trader or on your part, if you feel that you can get it cheaper outside of the contract, is always a possibility. However, forward contracts do allow you a mechanism to fix your buying or selling prices in the face of volatile commodity prices. Now come to the other kind of a derivative contract, which is futures. And the best way to understand futures is they're nothing but the same forward contracts being designed so that they can be traded on the exchange. So NCDEX may say, okay, there are a lot of people who are buying and selling soybean through forward contracts. So perhaps we can give them the opportunity to buy and sell the same contracts from the exchange. So hence the soybean contract of NCDEX. So they design contracts, exchange traded contracts that are standardized. Standardized in the sense, 4 features: quality, quantity, location for delivery, and date for delivery are fixed by the exchange. So like in the case of soybean, 5 tons is the quantity. There's a certain quality that is specified in the contract specifications, which are readily available on the NCDEX website, which I can share with you. Location for delivery, which are a handful of locations also specified in the contract, and the date, which is the 20th of each month. So they are standardized, so that there are, if you have a requirement to buy or sell that is quite close to the exchange contract, then it's always better to go through the exchange because of the clearinghouse protection that you have. So every exchange, NCDEX included, is backed up by a clearinghouse. So the clearinghouse is the entity in which every risk management process is executed, so that there is no possibility of any buyer or seller of the contract being exposed to risk because of any kind of default or any kind of non-performance of the contract. And these contracts are liquid and transparent, which means you can enter into a contract today to buy or sell, and you can exit from that contract tomorrow or later today, or 4 days later, whatever you like. So whenever you want, you can buy or sell the contract, and whenever you want, you can exit from that contract. So there's a lot of liquidity and there's a lot of transparency about what are the prices prevailing for you to buy the contract or to sell it. So there's a lot of reporting happening because these are regulated by SEBI. There's a lot of reporting happening and being brought out in the public domain. So every day, end of the day, or during the day, you can actually see the prices at which contracts are trading. At the end of the day, you can see a complete consolidated information about what was the price at which the contract opened today for trading, what was the highest price it touched during the day, what was the lowest price it touched during the trading day, and finally, what was the price at which it closed for trading today. So a lot of very well reported information, how many contracts were bought or sold throughout the day, and how many contracts remain open at the end of the day. Everything is there. So the disadvantages are there's a little bit of inconvenience because you are asked to deposit margins, a small amount of security deposit, you may understand it as. You are expected as a buyer or seller of a contract on the exchange platform, you're expected to deposit some security, which is in the form of a margin. And if you have a profit in your position, cool. But if you have a loss in your position because you bought at a certain price and the price has fallen, or you sold at a certain price and the price has risen, then you have a loss in your position, in which case you are required to deposit more money. So every day you're mark to market, which is often considered as a little bit of a inconvenience, or it requires you to remain very alert and engaged with the market. You cannot just sleep over a futures contract. But once you've started trading in futures contracts, this becomes a matter of practice. There are many things that your broker will do for you to enable you to make less of a to make this whole process much more easier. They're inflexible because they're standardized, they're inflexible, they do not allow you to change the quality quantity of the contract, and there is basis risk. So basis risk is there's a certain quality that is specified in the contract. The quality you may be buying or selling may be slightly different, or the location on which you may be buying or selling may be slightly different, and the prices of the futures contract and your own buying or selling prices may not move in perfect correlation. So there can be some basis risk, which I will elaborate in our discussion as we go forward. But then it's not such a big issue that it should stop, because basis risk is usually very, very small. And the small case study that I've developed for you today will help you see that basis risk is normally a acceptable, or okay, I can manage the basis risk. I cannot live with the price risk. Price risk can wipe you out. Basis risk will never be so damaging. A third kind of a contract is our option contracts. Option contracts can be built on futures or they can be built on spot. And in India, SEBI has been very, I must say, very progressive in allowing NCDEX to launch options on spot, because in the commodity markets globally, options are built on futures. But for soybean, options are on spot, and also for wheat and maize. So what does that mean? That rather than buying a futures contract and fixing the price at which you will buy or sell at the future date, or rather than selling a futures contract and fixing the price at which you will sell at the future date, what you do is you buy a contract and say, okay, at this price, I have the right to buy, but I have no obligation to buy. So what happens is, let's say you fix a price to buy in September of 8,000 rupees a quintal or 7,000 rupees a quintal, right? Now in September, when you really want to buy from the market, if the price is 8,000 rupees a quintal, good for you. You have a price of 7,000 logged in for you because you have an option contract. But if the price is 6,000 rupees a quintal, you say, forget it. I'm going to go and buy from the market at the market price, which is lower than the price which is agreed in this contract. So you have the best of both worlds through an option contract. In the face of rising prices, if you're a buyer, in the face of rising prices, your maximum buying price is fixed. You will not have to pay more than that price. But if the prices in the market fall in the face of falling prices, you can always go and buy from the market at the lower price. Now, sounds too good to be true, right? In order to get the right to buy at that price, you have to pay a small upfront money called the premium. You have to pay a small premium. So it's like saying, fine, let's enter into a contract where the seller will sell soybean to you at 7,000 rupees a quintal. Even if the market price is 10,000, 12,000, whatever, 7,000 is a fixed price. But if you want, you will not buy at 7,000, you will go and buy from the open market at 3,000, whatever, for which you may have to pay a premium of something like 200 rupees a quintal, right? So you say 200 rupees is my upfront premium. If the prices rise, I will buy at 7,000 and my effective buying price will be 7,000 plus 200, 7,200, right? So options make the buying a little more expensive because of the premium involved, but then there's so much flexibility. Okay, I must change this. I don't know why I've written inflexible here. It should be flexible. So let me just change this and correct this so that it doesn't confuse you. So there is a this inflexible is not a uh, is not is not a risk, is not a disadvantage here. So that is so there is a limited amount of risk you take. What is the risk you take? Only of 200 rupees. Why? Because if the market prices fall, let's say the market prices fall to 6,000. You say, okay, you keep the 200 rupees. I'll go and buy from the market at 6,000 rather than buying under this contract at 7,000. Right? In which case your actual buying price will be 6,200. 6,000 that you pay to buy the commodity, and 200 is the premium that you that you forego. So that 200 rupees of premium that you pay to buy an option contract that gives you the right to buy at 7,000 without any obligation to buy at 7,000, it's an added cost. And so the limitation here is that option contracts turn out to be more expensive than futures contracts. Using option contracts turns out to be more expensive. That's it, nothing else, right? Now, the third advantage is that there is no mark to market. Once you pay a premium, that's the maximum loss you can suffer. So as a buyer of the option, you don't have to worry about being mark to market or about having to pay extra margin if you get into a loss, because the maximum loss that you could incur is 200, which you've already paid. But if you've sold the option saying you've taken 200 rupees and taken on the obligation to sell at 7,000, whatever the market prices are at that time, then if the market prices start rising to 7,500 or 8,000 or 8,500, you will have to deposit margins with the exchange so that you don't run away saying, why should I sell at 7,000? Let me default. Okay. So the seller of the option who takes the margin, who receives the margin and takes on an obligation is margined. But the buyer of the option who pays the premium and gets the right to buy at the price, which is called the strike price or the exercise price of the option, is not exposed to any kind of a margin. And of course, when you trade option contracts on the exchange, they can also be traded off the exchange. But mostly these kind of simple option contracts, which we also call as plain vanilla option contracts, are traded on the exchange. They're very liquid and very transparent because you can buy a contract whenever you want, you can sell the contract whenever you want. And the prices at which contracts are being bought and sold are being reported on a real-time basis, and so they are very, very easy to track or audit and or know where the prices are going. No one can take you for a ride. And the fourth kind of a hedging instrument or a derivative contract are swaps. Now, in the commodity world, swaps are not common except in crude oil. So in the commodity world, the one commodity where you see swaps being used are in crude oil. You don't see swaps being used in other commodities. Now, what is a swap contract? Let me briefly tell you, because I'm trying to, give you an idea about the hedging instruments that are there. Swaps are again over the counter. The exchange is not involved in swap contracts, and again they're customized. Whenever the exchange is not involved, contracts can be customized. Whenever the exchange is involved, contracts will by necessity be standardized. So they're OTC and customized. And again, whenever the exchange is not involved, there is no clearinghouse backing up a contract. So the risks are very high. But what happens in a swap contract is, let's say I need to buy a commodity, and my first instinct will be, if I need to buy a commodity, I must protect myself against rising prices. That's my first instinct. So I go to my seller and say, look, you are the seller of the commodity. I am the buyer of the commodity. You are exposed to the risk of falling prices. I'm exposed to the risk of rising prices. So why don't we enter into a contract for the next 3 months or next 4 months or next 5 months or next 1 year, next 2 years, next 10 years, whatever. Why don't we enter into a contract and fix a buying and selling price? So whether prices rise, I'm not exposed to risk, or they fall, you are not exposed to risk, and net we are both protected against price volatilities. That would be a forward contract. That's exactly what you do in a forward contract. But let's say your seller says, I don't think the prices are going to fall. I'm not worried about falling prices. For whatever reason, I'm not concerned. I don't want to get into a contract. So the choice of a forward contract is ruled out for you. That route of entering into price risk management strategy with a forward contract is ruled out. Then what you can do is you can go to a third party or a financial intermediary, which could be a bank, which could be a hedge fund, which could be an investment bank. It could be any kind of a third party or an intermediary. And you say, look, I am a buyer of a commodity and I'm concerned about rising prices. My seller doesn't want to get into a forward contract with me. Can you enter into a fixed price contract with me? Which is to say, can you give me a fixed buying price for my commodity, whether prices are higher or lower? So let's say the agreement with the financial intermediary is fine. Let's fix a buying price of 7,000 rupees per quintal for soybean. Now, if you buy soybean from the market for 7,200, we will give you 200 rupees per quintal. So your net buying price will be 700. But if you buy the soybean from the market for 6,800, you give us 200, so that your net buying price is 7,000 again. Okay, so what is happening in the swap contract is you as a buyer, in my example, you as a buyer are able to exchange a volatile cash flow, because sometimes you're buying it above 7,000, sometimes you're buying it below 7,000. You're able to exchange a volatile cash flow for a stable cash flow. You're fixing a price of 7,000, and the volatility of the ups and downs in the prices are passed on to the financial intermediary. So that is a swap contract. It is uncommon in commodity markets. It is usually entered into for one more time. I need to correct this. It is usually entered into for large contract sizes. So, if you are a small player in the commodity markets, then you may not be able to, or you will not be able to find a swap counterparty. Unless you are, doing it at an organizational level. So large contract sizes, it's a long negotiation process. The negotiation for swap contracts is normally very long and very complex. And these contracts, again, all OTC contracts are customizable. They have no clearinghouse protection. They're exposed to counterparty risk, and they are illiquid. So again, even a swap contract is illiquid. There is no way you can exit from that contract even if you want to. Now, that was my brief explanation of the 4 types of derivative contracts that I think you should all know for being able to use derivatives for price risk management, market-based instruments for price risk management. Now, please, I will appreciate if you can unmute yourself, or you can do what? If you can, type in here and say any questions that come to your mind. Any questions that you have. Do you have some amount of clarity about the various types of derivative contracts? Okay, I think so some clarity with instruments that is there. Clear with instruments. Anyone else? Are there any questions you have? I will be happy to answer. Otherwise, I will proceed. This I've already discussed with you, that when you use a forward or a future contract, you actually fix a price. And then if prices rise, you have a profit. If prices fall, you have a loss as a buyer. As a seller, it is opposite. Okay, but if you use, I'm sure you can understand, if you use, just see where my cursor is going. If you use an option for buying, it's called a call option, by the way. If you use an option to buy, fix your buying price, then your losses will be limited to the amount of premium you paid, but your profits will be unlimited. Okay. Now, I have been talking about the various kinds of derivative contracts that are available for using market-based price risk management. Now, let me talk to you about the exchanges. When I say futures markets, I mean the derivative markets or the exchanges where these derivative contracts are traded. For example, NCDEX. There are essentially three kinds of participants that you will find on these exchanges. And I think you know these terms very well because you know speculators, you or many of you may be agreeing with the school of thought that speculators are leading to price rises. Many of you may be on the fundamental side. So the kinds of participants who are there in the derivative markets are hedgers, especially in the exchange traded derivative markets. They're hedgers, speculators, and arbitrageurs. Who are hedgers? Actual business people, people who actually need to buy or sell a commodity in the spot markets or in the physical markets you know, so they may need to buy the commodity because they're processing it further to make something else with it. So you are buying soy meal to make feed with it. You're buying soybean in soya meal in the spot market, processing it, making soya meal and I'm sorry, buying soya meal, processing it, making a feed and selling it to maybe some fixed customers who you have. So you are risk averse. Why are you risk averse? When you do a business, you are you know, you embrace risk, you enjoy risk, but you are risk averse because you say, look, my business is to buy soya meal, process it, understand the requirements of the poultry industry or the fisheries industry, whoever you're supplying feed to, and make a product or make meal that is useful for them, that is you know, loved by them. So my business is to make very good feed quality, to maintain my customers, to keep them happy, to have a goodwill in the market, to know what are the latest techniques of making feed, to know what are the scientific developments that are happening in this area. That's my business. I take risk in that business. The ups and downs in soya meal prices is not my cup of tea. That is not a risk I have agreed to take. So that is why I would like to remain risk averse when it comes to the volatilities that I have to be exposed to because of ups and downs in soya meal prices. So you are risk averse, not because you are not for any other reason, but because you're focusing on your core business. And then there are speculators who are professional risk takers. They come to the market because they like to take risk, hoping to make some profit out of it. So when someone is trying to buy a contract because they feel that the prices might rise, the person who's selling the contract to them, hoping that the prices will fall, is normally a speculator with the contrarian view. And speculators are, while we mostly tend to think about them as, you know, spoilers or as people who damage the market, speculators are very important market participants because they add depth and liquidity to the market. If speculators are not present in the markets, then there is no one to take the risk or accept the risk that the hedgers want to give away. So speculators are very important market participants. Exchanges and regulators and policymakers have clearly understood their role in keeping the markets deep, active, and liquid. And there are in place a lot of measures that stop them, that kind of prevent them from hijacking the market. So some of the measures that exchanges will have in order to prevent speculators from hijacking the markets is what are called as price limits and circuit filters. They have daily price limits. Exchanges will set price limits which are plus minus of the previous day's close price, and they normally do not allow prices of trading a contract, the price at which a contract is trading today, to move outside of that range freely. If the prices are trying to move outside of the price range set by the exchange, then the exchange will first study why the prices are trying to move outside. Is this an international trend? Or is there a fundamental reason which is causing the prices to move up or down? If that is true, if there is a rationale for the prices to be, pushing the ranges set by the exchange, then the exchange may allow that price range to be broken. Otherwise, the exchange will stop trading. So one is, speculators do not have a free run on exchanges. There are price ranges to which which controls them. Then there are what are called as maximum allowable open positions. No one buyer or seller is allowed to have just 1 second. Just 1 second, please. So, can you hear me? Yeah. So, no one buyer or seller is allowed to hold more than a certain number of contracts. So you cannot really corner the market because there is a maximum allowable open position. Then there are margins. Margins are, good faith money, security deposit, forces speculators to invest money if they have losses in their positions, or even if they want to take positions. And so speculators are important participants who are allowed to come to the markets, but with checks and balances. And then there are arbitrages. Arbitrages are those who are, who try to make risk-free profits in the market by spotting irrational price differences between the spot markets and the derivative markets, and buying in the cheaper market, selling in the more expensive market, trying to make a profit from that. So these are three kinds of participants who are commonly found in any derivative exchange platform. And we are going to have I have a comparison in the next slide for you to see. See here. Here is a comparison of hedgers with speculators, and anyone who is a value chain participant, VCP, as we say, a value chain participant, is advised to come to the markets as a hedger, not as a speculator. Don't get talked into, don't get motivated by anyone to come to the markets to speculate. Come to the markets to hedge. So what do you do as a hedger? First, you have a position in the spot market or the physical market, which means you're either a buyer or a seller in the actual market. You're actually buying or selling the commodity, because of which you have a exposure to price risk. If you're a buyer, the price risk exposure you have is rising prices. If you're a seller, the price risk exposure you have is falling prices. So what do? You go to the derivative markets or the futures markets and you buy or sell a futures contract. You create a second position, a backup position in the futures market, such that it counters or it negates the risk you already are getting exposed to in the spot markets. So you use the futures markets. When you're a hedger, you use the futures markets or the derivative markets to offset the risks you are exposed to in the physical markets. So the position or the trade that you do in the futures contract is not based on price views. It is based on what position you have in the spot markets. By buying or selling a futures contract as a hedger, what you're doing is, your objective is, you're trying to change your price risk exposure into basis risk. Hedging changes price risk to basis risk. We'll understand this again in an example how. But what you must understand is, hedging does not mean complete elimination of price risk. What you do is you give away price risk to the speculator, but what you take in its place is what is called as a small acceptable risk called basis risk. And what else is there is, hedgers will hold on to their, if they've bought a contract, they'll hold on to that contract. If they've sold a contract, they will remain in as a sold side in the contract till they actually buy or sell the commodity in the spot market. So they kind of time their purchases in the spot market with their with exiting the futures contract. Now we come to speculators, completely different from hedgers. They come to the futures markets or the derivative markets despite having no position in the spot markets. They are not exposed to any risk. If they wanted, they could easily have sat without coming to the derivative markets. But they come to the derivative markets, they without having any risk exposure in this physical spot markets, because they see that there is a volatility in the prices of a commodity, and when there is a volatility in the prices of a commodity, they have an opportunity to make a profit by either buying the contract at a lower price and selling it at a higher price, or first selling the contract at a higher price and then buying it back at a lower price. So they create positions in the derivative markets to profit from the ups and downs of the commodity prices. So the positions that they are not trying to cover any kind of risk. They're trying to profit from the movements in the commodity prices. So the trade that they do in the derivative markets is, as contrasted with hedges, completely based on price view. If you expect prices to rise, if you're a speculator who expects prices to rise, you will buy now, you'll buy a futures contract now and sell when the prices rise at a higher price and make a profit. If you expect prices to fall, you'll sell a futures contract now and buy back if prices fall at a low price. So your trade is completely based on where do I expect prices to go? Do I expect them to rise or fall? So whereas the hedgers are trying to give away basis risk to, to give away price risk and in its place take basis risk. So the price risk they're giving away to speculators. Speculators take the price risk. They take exposure to price risk. And another thing about speculators is they close out their positions or they exit from their positions. So they don't remain with a buy contract or a sell contract for its entire life. They may be day traders, so they close out positions, they exit from their positions the moment they have made their profit, or so they have target profits, or they feel that they've made a wrong trade, and even if they have a loss, they'll exit from the market. So they are very short term. They don't hold on to their positions for a very long time. And so I've been talking about positions all the time. So I must tell you this. I must tell you two things actually. One is there are two kinds of market positions that you can have, short or long. Short is when you need to buy something. Okay, so you can be in the spot markets and need to buy soya meal. We say you're short soya meal, right? When you need to buy something, you're short that commodity or short that asset. Or you could have sold a contract in the derivative markets and you're short that contract, right? Why? Because ultimately you'll have to buy that contract to quit your position, to exit from your position. So you can be short in a position, in which case you face risk from rising prices. When you're short in your position, you face the risk of rising prices. And when you're long in your position, long comes from belong. When something belongs to you and you know that going forward you're going to sell it, when you need to sell something at a later date because it belongs to you, then you are exposed to the risk of falling prices. And then you say that you're long in your position is long. So just defining short and long position in the spot markets, in the physical markets, let's say you are a feed manufacturer. If you need to buy soya meal, if you need to buy soya meal, we say you short soya meal in the spot market, right? Similarly, if you go to the futures markets and if you sell a contract, which you will not, but suppose you go to the futures markets and sell a contract, then we say you are short the contract because you've sold a contract. And if you are a soya meal trader, you need to sell soya meal that you already have with you. You've stocked soya meal with you, which you will sell. Then you are said to be long soya meal. You own it, you will sell it, and you are exposed to the risk of falling prices. On the other hand, if you buy a soya meal or a soybean contract on the exchange, then you are long the contract. When you buy a contract, you are long the contract. And so just to give you a quick understanding, if you are a feed manufacturer, then you are short in the spot market here. You're short in the spot market. You are exposed to the risk of rising prices of soya meal, and you will counter that risk of being exposed to the risk of rising prices by buying a futures contract. So a short position in the spot market can be negated or can be hedged with a long position in the futures market. And a long position in the futures market, so if you're a soya meal trader and you stock soya meal which you want to sell at a later date, if you're a soya meal trader, then you are long in the spot market, and you will hedge yourself or insure yourself against the volatility in prices by going short in the futures market. So it is like this. Short and spot is managed by long in futures, and long in spot is managed by short in futures. That is the basic hedging strategy that we have. Now, okay, now before I proceed any further, let me just take a pause and ask any questions. Any questions from your class? Any questions from the class? Are you all able to follow what I'm saying? Would you like me to explain something specifically? Would you like me to change the direction of my discussion? Anything, please tell me. Are there any questions? That's my first question from you. Are there any questions based on what we've done? Have you understood everything? Everyone, have you understood? Are you following what I'm saying? Can we proceed from here?
Can we receive some affirmative answers? Because ma'am, it's like almost an hour into the session. We'd like to know if any of you have any queries, or we can proceed ahead.
So I've received one affirmative from a participant who's replied privately. Maybe you can reply to everyone so that, just change the setting to everyone. So this participant has said yes, he has understood. Thank you very much for your reply. Anyone else? If you have any questions, I'll be very happy to answer them. So maybe you can type here and just reply to everyone so that you connect with each other also. So I don't know whether you are understanding or whether you're everything or you're not understanding anything. That is the doubt I have in my mind. So then what happens is I proceed as I have planned, and maybe the connect is established or not established. So please tell me, whoever is there. I'm going to call you out by your names if you don't tell me. You know, I am a teacher and I'm very good at doing that. So Anjali, have you understood what I have? Oh, thank you, Anjali. Biswajit, Gopinathan, Harish, please tell me if you're following or if you want to know something specifically. Biswajit, Gopinathan, Harish, Jai Shankara, Mahesh. Okay, thank you, Tanya. Anyone else, please tell me if you have a question. Mahesh, Mubin, thank you, Mahesh. Mubin, please ask me questions. I'll like to answer. I'll be happy to answer.
Probably we can continue and we'll take all the questions at once.
Harish, thank you. Mridula, Niti, Nitin, Pavan, Rahul, Rajesh, Ranjit, two Ranjits here. Sandeep, can you please tell me if there is anything specifically that I need to discuss before I move on to explaining how to do hedging? Thank you, Ranjit. Ranjit Dhawale, Shiva, Siddharth. Thank you, Shiva. I hope you are understanding. Okay. Now we let us proceed with hedging. So I don't want, Bhupalini is also advising that. I don't want to spend too much time stuck here. So Bhupalini will give me an idea about the time.
It's 11:20, ma'am. We have like another hour because we started 10 minutes late. So
Roughly an hour. Okay.
yeah.
So the basic idea of thank you, Bhupalini. The basic idea of hedging is very simple. Do now in the derivative markets using derivative contracts. Why I've written derivative contracts is you could use futures or options, whatever is available on the exchange. So many times you may find that futures contracts are available, but options are not available. But in the soybean, for soybean people, I think the good thing is you have both futures and options. So do now in the derivative markets with either futures or options what must be done later, what you want to do later in the spot markets. If you want to buy at a later date, soya meal or soya bean, buy a futures contract on the exchange. If you want to sell at a later date, soya bean or soya meal, sell a futures contract on the exchange. The contract that you choose to buy or sell has to have an expiry which matches with the date on which you want to buy or sell in the spot market. So the whole idea is you're able to lock in the prices of a trade that you will do at a later date today. So do in the derivative markets using futures or option contracts, what you will do at a later date in the spot markets, so that you can lock in the prices of the spot market trade today. By doing this, you are achieving hedging through which you replace price risk with basis risk. And the whole thing is very simple. As a hedger, you must simply identify what constitutes an adverse price movement to you. What is a price movement? Is it upward or downward price movement, which is going to cause you a loss? What is an adverse price movement, and which is always relative to the activities of the business? If you're a buyer, a price rise is an adverse price movement. If you're a seller, a price decline is an adverse price movement. And if you're a buyer in the spot market, so you buy soya meal to make a feed, you buy a futures contract now if the commodity has to be purchased at a later date, and you sell a futures contract now if a commodity has to be sold at a sold in the future. So the hedging policy must be in place to guide the hedging process. And so all of you present here today, I want to tell you that whether you have already done hedging in the past or whether you want to start with hedging going forward, you may want to start with hedging 10% of your total purchases, 20% of your total purchases, whatever you want to do. Begin with giving some thought to what should be the framework for hedging, what should be your hedging policy. And so, a hedging policy is actually a kind of guidance to how you should hedge. And so the question that you must first answer in your head is, should I hedge or should I not hedge? Right? Is it for me to hedge or am I okay without hedging? Now, many a times we have misconceptions about risk, right? We tend to think about risk as something that we can pass on. Perhaps you can. If you're someone who buys soya meal at a higher price, but you are able to pass on the price rises to your buyer, well, then you don't need to hedge, right? But if you are stuck with a rise in the prices and you have to absorb that higher prices in your profit margin, then you have to hedge. So if there are any misconceptions about risk or in your head, please, clarify that, understand what is the risk and how it affects you. Any risk that affects you adversely must be addressed by you. Then you may have concerns about the costs of hedging, because hedging doesn't come free of cost. You have to take membership of a you have to become a client of a broker through whom you will hedge on the exchange, and that comes with the brokerage fees, and it comes with a deposit of a margin money. But believe me, the costs of hedging, you don't have to believe me, you have to, it's logical. And the costs of hedging are far lesser than the benefits of being protected against the damage that you can suffer to your profitability. Then there are fears about reporting losses on derivative transactions. So all the time that I have ever taken a session on hedging, the participants have come forward and said, ma'am, what happens if I lock in a buying price and the prices actually fall? Then I'm going to be questioned to question as to why did you lock in a price when the prices fell? Please remember that you don't take a view on prices, whether prices rise or fall. If prices rise, you would have a profit in your derivative trade. If they fall, you would have a loss on your derivative trade if you're a buyer, right? That you did not want to think about whether prices are going to rise or fall, and so therefore you are this question is not a question to be asked. But yes, I will point out here that if you are trying to speculate, suppose the total amount of soya meal you need to buy or sell is 100 quintals. But if you're taking a futures position or a derivative market position for 120 quintals, then you are speculating for 20 quintals. Anything over and above your spot market level of trading, if you're doing, then you're speculating. Now, if there are losses on a speculative transaction, then certainly you are answerable for that loss. So don't try to speculate with the derivative contract. You may do it in your personal capacity, but not in your official capacity, not because it will lead to agency issues. Lack of familiarity with hedging tools and strategies. Yes, that's a very big, limitation for hedgers. And this is exactly what a session on like this that NCDX has done is for. It gives you familiarity with hedging tools that I talked or hedging instruments and strategies. What are the derivative instruments available to you and how you use them? Those are the strategies. And then difficulty in convincing company boards. Please remember that no hedging should be done without the approval and the sanction of the company, right? So a hedging policy is important because it is presented to the company board, their approval is taken, and hedging is done within the constraints set by that policy. So the steps involved in hedging are identify your risks. What are the risks which for you? And which of the risks are operating risks, which is because my supplier is not dependable, my transporter has defaulted in the past, my warehouse is not large enough, I cannot stock more than 1 week of raw material. So whatever, these are operating risks. Financial risks are the risks that you can hedge, which is the volatility in prices. Distinguish hedging from speculation. You must know that if you do not have a position in the spot market and then you go and try to do a trade in the futures market, that is speculation. But if your trade in the futures market is backed up by your position in the spot market, then that is hedging. Compare the cost of hedging with the cost of not hedging. So for all of you who are concerned about hedging means there is a cost involvement, please think that if prices were to move against you, what would be the loss you would take, and then decide whether the cost of hedging is better or not hedging is acceptable. You have to decide what to do. Evaluate the hedge performance against the right yardsticks. So if you say, I had to report, you do your hedging for the first time, and then there is fortunately for you, the prices fall. As a buyer, the prices fall. You say, hedge karna hi nahi, I should not have hedged because I would have been better off without hedging. Did you know at the time that you hedged that the prices were going to fall? You did not, right? Now, it is just because the prices are volatile and they're unpredictable and they can move in any direction that you ended up with a loss on your derivative transaction. So you must have the right yardsticks for evaluating your hedge performance. Don't go about it with a one-time, movement in prices. If you look at it over a longer term, then sometimes prices may rise, sometimes they'll fall. The advantage of a hedge performance is, or the outcome of a hedge performance has to be, that your buying price or your selling price, if you are a seller, is known to you in advance. It's fixed for you. And so your budget certainty is achieved. Your budget is known to you with more certainty. Separate your hedge program from market. You don't try to hedge. I mean, people do try to do that. I'm not trying to say it does not happen. Okay, but if you're starting with hedging, Don't try to link your hedging decision with what you expect the prices to be doing. You've seen that prices have become volatile and they've risen, and so that's the market behavior. Don't try to be a speculator in doing hedging. Understand the hedging tools available. I have explained them to you, and establish a hedging policy. So what is a hedging policy? Before I go to hedging policy, I must explain you this. You see, hedging is not 100% solution. You don't do hedging all the time. And so I have this matrix which tells you when hedging should be, most optimally done. When is, without no questions asked, hedging the best thing to do, and when is some other way of risk management probably more appropriate. So let's talk about risks. Okay, now if you have a risk which has a low probability of occurrence, so maybe the commodity you're buying or selling is salt, right? Its prices don't move up and down. It's a stable. So the volatility in the price of salt is a risk which has a low probability of occurrence. Even if it does occur, its impact on your profitability is going to be less. Why? Because you buy limited amount of salt. It's not the main item that you process. You buy a limited amount of salt. How much can it damage your profitability? It cannot. So fine, if you are talking about salt, or if you're talking about say asafoetida, if you're talking about some flavoring agents, whatever it is, then fine, no action required. Don't bother about it. Live with that risk. It's a that risk will most probably not occur. Even if it does occur, it's not going to cause you a major damage. Live with that risk. But if you have a risk which has a low probability of occurrence, it occurs once in a while. But when it occurs, it washes out your, quarter. It washes out your 6 months. Then you must go for insurance, like a tsunami or an earthquake or a fire, right, or a theft. The probability of occurrence is less, but the impact of that risk, if it occurs despite its low probability, is very high. Then go for insurance, right? You will not be able to insure a risk which is a high probability of occurrence. Now, if you have a risk which is a high probability of occurrence, like volatility in the price of soya bean or soya meal, high probability of occurrence hoti rehti hai. We've seen volatility, day on day volatility we've seen. Day to day price changes are on an average 0.4%. So if that kind of volatility is there, it has a high probability of occurrence. I am, if I need to buy 15 days later or 20 days later, 1 month later, 2 months later, I cannot be sure about the price, right? So it has a high probability of occurrence, but the impact is low. Why I'm saying low impact of risk? Because that one buying or selling episode may leave you in a loss. But overall, it may be fine. But if the impact is low, because it's going to be, you're going to do maybe 24 rounds of buying in a year or 30 rounds of buying in a year. So maybe net you may be okay, right? But if the prices are on a continuous increase, on a continuous decline, then even net you're not going to be okay. But why I'm saying it has a low impact is because it's not going to wipe you out like an earthquake or a tsunami can. So if when you have this kind of a risk, which is especially a price risk, which is a high price volatility, which is a high probability of occurrence, but a relatively low impact, then hedging is the most optimum, the most sensible thing to do. And then finally, if you have a risk which has a high probability of occurrence and a high impact, then you should go for diversification. So what I'm trying to say is, if you are a feed manufacturer and soybean prices or soya meal prices are all the time very volatile, and they are because you are completely dependent on manufacturing feed from soya meal, think about diversification. Think about changing your input to some other meals. So you have to think about diversification as a strategy. But hedging is meant for a very specific kind of situation. So now what will your hedging policy? Hedging policy is a guidance for using the hedging tools that are available. So maybe you are in a country, we are fortunately living in India. We're not living in a country where we do not have access to an exchange platform, or we do not have exchange to a regulated, exchange traded, monitored, safe, liquid platform like NCDEX or like a commodity exchange offers. So when you are aware of the options, or I'm not using the term options, being aware of the choices that you have for hedging, what are the tools that you're going to use? Perhaps you will use only futures, or perhaps you'll use only options, despite the fact that options finally turn out to be a little more expensive. But then your hedging policy has to be clear on this. So the hedging policy is a guidance for using the hedging tools strategically to reduce financial risk on existing exposures. The hedging policy guides on the use of hedging tools, how they should, which tools they should be used, to what extent it should be done, how it should be done. So everything to achieve risk management. The hedging policy does not apply for the management of other exposures like operational risk. If you have an operating or an operational risk that my warehouse is not big enough, I should lease another warehouse so that I can stock more of a commodity, or that my my fire systems are not good enough and I'm exposed to the risk of fire. Those kind of operating risks are not addressed by hedging policy. Hedging policy only addresses risks that are manageable through hedging with derivative instruments. And so the policy is intended to, the objective of a hedging policy, and I'll also share a sample hedging policy with you. Maybe you can use that hedging policy if you want to develop your own company's hedging policy. Outline the objectives of hedging. Okay, as a company, as a business, why am I hedging? What is my objective for hedging? Is it to make more money? No, that's not the objective of hedging. The objective of hedging will always be to protect myself against volatilities in the price of a commodity that I'm buying or selling. And so you have to be first sure that there is a volatility. Then provide the guidelines on the use of derivatives. Which derivatives will be used? Now, if on an average during a quarter I buy 100 tons of soy meal, will I hedge myself for all the 100 tons, or will I hedge myself for around 50% only and keep myself open to the risk for the remaining 50%? So which tools will I use for hedging, right? What will be the strategies I will use? Will I take a membership of the exchange, or will I go through a broker? Who will be the person who will be responsible for hedging? What happens if I report losses on my derivative transaction? All these things have to be provided in the guidelines on the use of derivatives. And then most important, establish a control framework related to the use of derivatives. Maybe you would want to set up a one person responsible for running the hedging program, or a hedging desk, right? You may have a team of 2, 3, 4 people which is a hedging desk. It depends on the size of your business. It depends on the extent of your need for hedging. Or you may have one person. Usually in companies, the head of treasury is responsible for hedging. Okay, or it could be the head of purchase. But most of the times, 90% of the times, it will be the head of the treasury, the CFO or the head of treasury. So who's the one person who's responsible for overseeing the hedging process, and where all will the approval of the board be required? In your hedging strategy, the strategy that you develop as a part of your hedging policy, you have to pay attention to ensure that 4 things are addressed. What is the hedging instrument that you'll be using? Maybe you forbid the use of options altogether. You say only futures will be used. Or you say options can be used, but they have to be, maybe you define the amount of premium that can be paid, or the kind of options that can be purchased. So hedging instruments, which are the hedging instruments that you will use? Will you also be open to the idea of using OTC hedging instruments, or will you only stick to exchange traded hedging instruments? Then what is the hedging level, which means will you hedge 100% of your purchases or sales, or will you do 50% of it? Will you do 20% of it? Will you do 80% of it? It really depends. On an average, most companies will try to maintain a hedging level of 50%, right? Then what will be the hedging duration? For how far into the future, your purchases or sales, for how far into the future should be hedged? Are you going to hedge only for the next 1 month, or for the next 2 months, or for the next 3 months, right? Or maybe you could have a policy where you say, for the next, if my hedging level is 50%, then for the next month, I'm going to hedge 50%. For the month after that, I'm going to hedge 40%. For the month after that, I'm going to hedge 30%. For the month after that, I'm going to hedge 20%. You go on like that. And then when you go through this month, and the next month for which you've hedged 40% becomes, the immediately next month, you can step the hedging to 50%. So What will be your hedging duration, and will there be will it be the same for each month? You say, I'll hedge for 6 months into the future, but I'll hedge 50% for the immediately next month, 40% after that, and so on. And what will be the hedge timing, which means will you enter into a hedge the moment you recognize, the moment I know that I need to buy 20 tons of soya meal. Let's say I receive an order to supply feed to a poultry company. I receive an order. The moment I receive an order, and I have to give a fixed price, I give a fixed price. Okay, I'll supply you feed in September end. Okay, it's 21st August. Till September end, I'll supply you feed at this price per quintal. Okay, now you know that my selling price is fixed. And in order to manufacture so much feed, I'll need to buy, say, 200 tons of soya meal. So what do? The moment you recognize that you have a need to buy, you can go and hedge. Okay, the moment you say, "Acha, ab to risk ho gaya. Now I know I need to buy something. I'm exposed to risk. If the prices rise, today I factored in this price. If the prices rise, I have a risk. So let me lock in a price so that I'm not worried about prices rising." So will you do it immediately on recognizing the need to buy or sell something, or will you do it when, let me wait for the prices to move in my favor? If I'm a buyer, let me wait for the prices to fall. The moment they fall, I'll lock in the price. Or let me wait for the prices to rise. The moment they rise, I'm a seller, I'll lock in the price, right? So what will be your hedging timing? We normally say, don't try to time your hedge. The moment you recognize the need to buy or sell something, go for your hedge, right? Now so the whole thing is explained here. I'm going to talk today about hedging from the perspective of the buyer. But once I talk about this, because time is limited, when I talk about this, if you listen carefully and understand well enough, the hedging for the seller will automatically be understood by you. So I'm talking about, if you are a buyer of a commodity and you are worried about the prices rising, then what kind of a hedge you should be doing? So if you are a buyer and you need to buy a commodity at a later date and you're worried about rising prices, you can hedge either with futures contracts on the exchange, or if available, you can also use option contracts. Option contracts may or may not always be available. Now, with a futures contract, the kind of hedge that you do is called a buying hedge or a long hedge. And it's used by buyers who have a naturally short position. Naturally short position, which means in the spot markets, going forward, they need to be buying something. So what do they do? When you have a short position in the spot markets, you take a long position in the derivative market. So long hedge is done when you have a short position in the spot markets, you take a long future position in the derivative markets, right? So how does it proceed? Yeah. At the time that I need to be buying a commodity in the spot market, I've received an order to supply feed. I need to buy soya meal to make that feed. I need to buy soya meal, 15 days later. Maybe one round of buying will not suffice. I'll have to go to the market 3, 4, 5 times to be able to buy. So I'll be buying by the end of August or in the first week of September, and the prices may have risen by that time. So today I know that in the first week of September, I will be buying a commodity. The moment I know I have identified the need to buy the commodity at a later date, I buy a futures contract corresponding to the date of buying the commodity when I want to start production. So if I want to start production on the 10th of September, I say, okay, I'll buy the commodity on 5th, 6th, 7th, and 8th of September, right? So that I can start production on 10th of September. I buy a futures contract corresponding to 5th, 6th, 7th, 8th September. As it happens, on the exchange, you will not have contracts for exactly the dates on which you want to buy. So what do? You use the contract which is going to expire soon after the date on which you want to buy. So 20th September contract, the contract on NCDEX, which is going to expire on 20th September, will be the optimum contract for you. That contract is the contract you buy at the price at which it is trading today, and that price of buying is locked in for you. Now, when you go to the market to buy your commodity, see, on 5th, 6th, 7th, 8th September, you'll go to the market to buy soya meal. So when you go to the market to buy the commodity from your regular supplier of soya meal, from the regular trader who gives you, ask him to deliver soya meal. buy the commodity and the futures contract that you had bought, right? You sell that futures contract. Don't take physical delivery from the exchange, because the quality that is supplied to you may not be the quality you're looking for. The location on which it is supplied to you may not be the location you're looking for. And ultimately, don't forget that this contract is going to expire on 20th of September. So delivery will only be done on 20th of September, or actually 1 or 2 days after 20th of September. And you want the delivery today because you want to start production on 10th of September, right? So you can't buy through the exchange. So you buy your commodity from the spot market, and the contract that you had purchased earlier on the exchange, you sell that contract on the same exchange. If the prices have risen, the prices for the contract would have risen. So suppose you bought the contract for 7,000, but now the prices have become 7,800. When you sell the contract, you make a profit. You bought the contract at 7,000. Now you're able to sell it at 7,800. You make a profit of 800, right? But now the price of the commodity in the spot market will also have risen. You buy the commodity in the spot market, you make a loss there. The loss that you make in the spot market when you buy soya meal is offset by the profit you make in the futures market, except that because of basis risk, the profit you make of 800 in the futures market may not be offset exactly. Either you will make a loss of 780 or 790 in the spot markets, or you will make a loss of 810, 820 in the spot market, something close to 800, but not exactly 800. That's basis risk. Okay, because the spot market prices do not move in 100% correlation with the futures market prices. I was supplied, I took out data for soya bean, refined soya oil, and soya meal prices of the futures. Actually, soya bean and soya meal prices. I'm sorry, let me say this again. Soya bean and soya oil prices of NCDX futures contracts with the spot market prices of soya bean and soya oil. I tried to correlate them, and the correlation is very strong. So when the prices of the futures contract rise on NCDX, when the prices of the soybean rise in Indore, the futures contract prices have also risen. When the prices fall, the futures contract prices have also fallen, and vice versa. So there's a very strong correlation. So the basis risk is quite low. It's quite minimized. But there will be some amount of basis risk, because depending on the quality you buy, depending on the date you buy, depending on the location from which you buy, there can be some difference. Now, see, if this is the price you fixed, let's say the price you fixed was 7,000. If the prices increase, which was your worry in the first place, if the prices increase, when you sell your futures contract, which you had bought, when you sell it, you'll have a profit in the futures contract. Out here, you'll have a profit. But out here, when you buy the commodity in the spot market, because the prices have risen, you will have a loss. And the loss will be almost almost exactly offset by the profit in the futures. The loss in the spot will be very closely offset by the profit in the futures. Maybe a little bit of difference may be there, which is okay. It's not going to damage you. It's acceptable. It's not unwanted. It is negligible. That is because of basis risk. Okay, so I also, it is possible that the prices can fall. That's where I was talking about reporting losses. I just want to tell you that when it comes to Indore, because Indore is the benchmark market for soybean prices. For Indore, if you're taking delivery from Indore or giving delivery in Indore, in this case, you're a buyer in my example. So if you're taking delivery from Indore, the basis risk will be virtually zero. It's negligible. But if you are in any one of the other delivery centers like Latur or Asola, whatever other delivery centers are there, then there will be some amount of basis risk. So basis risk actually depends to a large extent on the quality that you're buying or selling, how closely it matches with the quality that the exchange has specified, and the location. If the location is the same as the location with which the exchange has benchmarked its contract, which for soybean is Indore, then the basis risk will be virtually zero, negligible. Then you are really happy, in a hedge like this. Now, when I was talking about reporting losses on derivative transactions, this is a situation. Suppose, all the time as a buyer, you are worried about rising prices. But what if prices fall? You thought, okay, I have locked in a price of 7,000 because prices are expected to rise above 7,000. But to your surprise, prices actually fall. You were not expecting prices to fall. And as a buyer, you should logically be worried about rising prices. But, unexpectedly, the prices have fallen. Then you're stuck in a situation where the futures contract is going to give you losses. That's where, many hedgers say, what if I report a loss in my derivative transaction? Fine. You did not know that the prices were going to fall. So what happens is that the prices fall. Then when you sell the futures contract that you had bought earlier, when you sell that futures contract at a lower price, you will have a loss. But when you go and buy a commodity at the lower price, and if you're doing it in Indore, it will be exactly almost the same. When you buy the commodity at a lower price, you will have a profit, and the profit that you make in the spot market will be offset by the loss you have to incur in your futures position. Now, unless you're someone who said, I could have done with the unexpected profit, if you have been factoring in unexpected profits in buying your raw material as one of your contributors to profit, it's a different matter. But what this hedge is really assuring you is one single guaranteed buying price of 7,000 plus minus a very negligible basis risk. So you can confidently proceed in your day-to-day business, knowing that your effective buying price will be 7,000 or thereabouts. You will not have to worry. Now, you can do the same thing because on NCDEX, you've got option contracts also. You can do the same thing with option contracts. Buy a call option. Buy a call option. With a call option, it's something like this. Pay a small sum of money called the premium to the seller of the call option, who will be a speculator. So pay a premium and fix a buying price. Let's say you fix a buying price of 7,000 by paying a premium of 200. I'm not changing my example so that I don't confuse you. Fix a price of 7,000, pay a premium of 200. This time your situation is different. You bought a call option. Now, if the prices rise to 7,800, 8,000, whatever level they rise to, you have the right to buy at 7,000. And you will exercise your right to buy at 7,000 plus 200 premium you paid. Your buying price is fixed at 7,200, whatever happens to the market price. But you will not have to report losses on your transaction here, except the 200 rupees you paid as premium, because if the prices fall in the market to say 6,000, you can just forego your 200 rupees, premium, and go and buy in the open market, not through the contract, but in the open market at 6,000 because the prices have fallen, right? So your effective buying price is going to be 6,000, the price at which you buy the commodity, plus 200, the premium that you have foregone. The premium is an upfront payment. It gets added to every price that you pay. So you can buy a call option, right? In which case your added cost will be the premium that you paid, but the benefit you will have will be that in case prices fall, you will be able to buy from the market at a lower price. You're not under any compulsion. In a futures contract, you're under a compulsion to buy at the price that you have fixed. In this case, there is no compulsion. There's another strategy which I guess may be a little advanced for you, but I still do want to talk to you about it. It is not necessary that the only choice you have with option is buy a call option. As a buyer, you can buy a call option. That's your primary strategy. That's your anchor strategy. You have to buy a call option. Buy a call option, pay a premium of 200. Okay, but what you can do is parallelly sell a put option and receive a premium, right? And so the effective premium you've paid is the premium you paid to buy the call option minus the premium you received to sell the put option. That's your effective premium. So the cost of the strategy is lower, but your actual buying price is bad. This is called a collar strategy. Actually, it's called let me write out here so that you can read about it when, or at least understand it when you read about it later. It's called a collar strategy. A collar strategy is where you are buying one option and selling another option. Buying a call, if you're a buyer, buy a call option. Because you're a buyer, you cannot escape buying a call option, and sell a put option. So what you're doing is paying a premium at the time of buying a call option, receiving a premium at the time of selling a put option, and so the net premium paid to buy, call, and sell put is your cost. Your cost is reduced, right? Except that what happens is if prices fall very sharply, you will not be able to take full advantage of the fall in prices. Because when you sell a put, someone who buys the put from you is has the right to sell to you at that price. I don't want to complicate it for you further because it becomes a little understanding options becomes a little complicated, but selling a put limits your freedom to buy at lower prices. At this time, I'll only tell you that selling a put option restricts or limits your freedom to buy at prices lower than the price. It's called the strike price of the put you sold. Selling a put option restricts your freedom to buy to buy at prices lower than the price or the strike price of the put you sold. So there is a bit of a catch here. It's a little bit of an advanced strategy to discuss in 2 hours. But I just want to tell you that it is possible to reduce the cost of using option contracts by going for a collar. And I'm not, what I'm going to do is I have an example in these. This is the payoff of a strategy where you buy a call option by paying a premium. You don't receive any premium by selling a put. This is the payoff of a strategy where you buy a call, buy a call and sell a put, short put. But I'm not, and this is an example to buy a call and sell a put, but I'm not going to discuss it with you because I don't want to confuse you today. Okay, so in the next about 10 minutes that we have, 10, 12, 15 minutes, I'm going to discuss a very, very simple example with you with some data that is available with me, and this data is okay, just give me a moment. Let me take so this is data of futures prices from NCTEX. Okay, this is data of futures prices from NCTEX. And I'm going to share this data with you so that you can see it. This is NCTEX prices. Taking a lot of, so what these prices show you is, let me just include. Can you see this Excel file? Can you please confirm if you can see my Excel file?
Yes, ma'am, it's loading.
It's loaded, right? So here is a long hedge example. Okay. Here are, let me just make this bigger and move this here. And I have talked about, some dates from 1st June 21 to 5th August 21. Okay. And what you have here is the example we have. Let me take you to the example. Let me see if you can you see my slides now?
Yes, ma'am.
Yeah. So on what happens here is on, let's say on 15th June. On 15th June of this year, you identify for some reason the need to purchase soybean, it could be soy meal, for further processing or for supplying as it is to a buyer on 10th July 21. So on 15th June, you know that on 10th July you have to supply to someone, but the price has to be fixed today. The price has to be fixed today, and the quantity that you have to purchase is 500 tons. Now, please remember that one contract of soybean or soy meal on NCTEX is 5 tons. And here we're talking about 500 tons. Now, as on 15th June, when this situation is being discussed, you do not have stock of soybean or soya meal with you. You have to buy it. To supply it or to process it, you have to buy it. So you're short the commodity. You don't have the commodity with you. So your position in the soybean is or soya meal is short, and you're exposed to the risk of rising soybean or soya meal prices. So what you can do is you can fix the purchase price of soybean or soya meal, as the case may be, today by referring to today's price of NCGX futures contract for soybean or soya meal. Soya meal contracts are not yet actively trading, so soybean futures contract expiring on 20th July. Because you are, you are looking at this date of supplying on 10th July, the contract that is reasonable for you is the contract that's expiring on 20th July. Now, the price of the NCTX soybean contract for expiry on 20th July on 15th June is 7275 per quintal. You must also prepare a purchase plan. A purchase plan means what are the dates on which you're going to buy the 500 tons so that you can supply on or start processing on or supply on 10th July. By 10th July, that commodity must be available with you. So you decide that you're going to buy on some dates in July. So what you do is the moment this need is identified, you know that I will have to buy soya bean or soya meal on by 10th of July. You buy the 20th July futures contract. You buy 100 contracts of 5 tons each if you hedge 100%. If you want to hedge 100% of your purchases, you will buy 100 contracts. If you want to hedge only 50% of your purchases, which means 250 tons, you'll buy 50 contracts. So it really depends on how much you have in your policy defined that you want to hedge. Now let's come here to this. So what you do is, so you can see that on 15th June, let me take you up. The price of the futures contract on NCGX is 7275. So this is the price that you will, let me change the color. This is the price that you will fix. Now you will sit, okay, you don't have to do anything. You have decided that you will do your buying on these 4 dates, 1st, 2nd, 5th and 6th, 4 dates, because you know that if I need to buy 500 tons, then probably one visit to the, visit to the mandi or one episode of buying from a trader will not suffice. You'll have to do 3 or 4 rounds of buying. So you fixed 4 dates for yourself. I'll buy on 4 or 5 days, 1st, 2nd, 5th, 6th, if need be, 7th, 8th July also. So then what you do is you go ahead like this. Okay, you can see the prices here. These prices, just note these prices, or maybe I can even copy it and paste it onto the slide to show it to you. So what you do is, on 1st July, you go to the market and buy 100 tons, right? You buy 100 tons. So which means 1/5 of your requirement you've purchased, and this is equal to 20 contracts. The price at which you could purchase in the spot market is, you can see on 1st July, the spot market price is 7345. So you pay 7345, whereas you are expecting 7275. So you have a loss of 70. But 20 contracts of the 100 contracts that you purchase, 20 contracts, 1/5, you square off, you sell. Not all the 100, but 20 you sell. The price at which you sell is 7422, because that's the price of the futures contract on the exchange. You bought at 7275, sell at 7472. You make a profit of 147, and so your net profit is 77. Even though this is basis risk, which has worked in your favor, even though you had to buy at a higher price in the spot market, you could square off at a higher price in the futures market. And so the loss that you had in the spot market is more than covered because of basis risk with profit in the spot market. Then again, you go on 2nd July. This time you're able to buy 120 tons, right? So the price is 7485. It's moved up a lot. It's moved up substantially. So you make a loss of 210 in the spot market compared to the price, expected price of 7275. 24 contracts of the remaining 80 you sell. The price at which you're able to sell is 7473, right? So the 7473 selling price means you make a profit of 198. So 210 loss in the spot market, 198 profit in the derivative exchange means a total loss of 12. Again, basis risk, this time working to your disadvantage. Then on 5th July, you are able to buy 130 tons. The spot market price is 7634. So you make a loss in the spot market because of the higher price. You square off from the remaining 56 contracts, you square off 26 contracts. The square off price is 7571. The purchase price was 7275. You make a loss of, you make a profit of 296 because the price is higher than your purchase price. But net, you still make a loss. And then on 6th July, you are able to buy 150 tons at a higher price again. So again, you make a loss in the spot market. You square off the remaining 30 contracts for a profit of 275 and the total loss is 19. So once the basis risk worked in your favor, 3 times it worked against you. So this way, in this, according to this, example, you have purchased all your 500 tons and squared off all your 100 contracts. Right. Now, just look here. What is the net result of this hedge? Now, let's say that you had built in a profit margin of, if you were supplying a profit margin of 200. So you had quoted a price of 7275, which was the futures price, plus 200, 7475. So the price you quoted was 7275 plus 200, 7475. So the margin that you built into the trade was 200 per quintal for 500 tons, right? So 10 lakh rupees. Now the total loss on the purchase of 500 quintals will be, you can calculate the loss with each, a profit of 77 on 20 contracts, and then a loss of 12 on 24 contracts, a loss of 63 on 26 contracts, a loss of 19 or 30 contracts. So the total loss on the purchase of 500 quintals, if you look at this, is 12,29,000. The total profit on the purchase of futures is 11,81,000. So the total loss you have is 47,800. Right? The loss you have incurred on this hedged trade is 47,800, which is kind of a loss in your margin of 10 lakhs. If you had not hedged, then this part would not be there, futures part. Then your loss would have been 12,29,700. And then your margin would have been wiped out and you would be left with a loss of 2,29,700. Right? So hedging by buying a futures contract has helped you to reduce your price risk of 12,29,700 into basis risk of 47,800. So you can see here, the cost of hedging in this whole example will not exceed 5,000 rupees. The cost of hedging will not exceed 5,000, brokerage and commissions and whatever. It will not exceed 5,000 rupees. But the cost of hedging is far overtaken by the cost of not hedging. So it is for you to decide whether you want to hedge or not hedge. Okay. Even that loss of 47,800 has been due to basis risk. So I've explained basis risk in this slide. This hedge, as you may have noticed, is not a no profit, no loss proposition. It's not, completely zero profit, zero loss. There is, in this example that I have taken, a 47,800 loss because of basis risk. What is basis risk? The basis risk is the risk that the prices, as they have moved up, we've seen that over the 4 days in which we have done our buying, prices have moved up in the spot markets as well as in the futures market. But they've not moved up by the same amount perfectly. And sometimes they've moved up more in the futures market and less in the spot markets. And sometimes they've moved up more in the spot market and less in the futures market. But net, your total loss is finally only 47,800. If you had not hedged, it could have been 12,29,000, much, much bigger, several multiples of 47,800. So basis risk is the risk you take in place of price risk when you go for hedging. And there can be many different types of basis risk. One is because the price basis risk is because the prices in the spot and futures market have not moved up or down exactly same way. Two is because of the location, in which, like I told you, in the case of Indore, the basis risk is almost negligible. It could be because of the dates on which you're buying. And since you're buying on second, whatever dates of July, there can be a little second, third, fifth, and sixth. Then there could be a little bit of basis risk. First, second, sixth, and fifth and sixth. And then quality. The quality of the contract may be moving in a certain way than the quality that you're actually buying or selling in. Now, let me tell you, even if you are hedging soya meal, you could do it with soya bean, because I studied the correlation and it's quite a good correlation. So you can actually, manage the price risk volatility in soya meal with hedging through contracts of soya bean. You will be still able to achieve a decent hedge. And my recommendation to you is you try to begin with hedging, 10% of your total purchases. So what does this financial hedging really achieve? It actually achieves nothing but a predictability in your profitability, a predictability of your budgets. So if you there should be no fear of what will happen to my profit margins. What if the prices move so drastically against me that my profit margins get wiped out? That will not happen. Your profit margins will be protected, uh, almost fully, except for a little bit of a positive or negative impact of basis risk on your profit margins. It could be both ways. I want to tell you that you can actually calculate a hedge ratio. And a hedge ratio tells you what percentage of your total buying or selling requirement should be hedged, right? So you may, through your hedging policy, decide it should be 50%, right? But so if you're going to buy 500 tons of soybean or soya meal, then 50% need not always translate into 250 tons or how much is that? 50 contracts. It should not always translate into 50 contracts. How much that will translate into will depend on hedge ratio. And the hedge ratio is calculated as rho sigma S upon sigma F. Rho is the correlation coefficient of the change in the future and spot price, which is 0.64. Sigma S is the standard deviation of changes in the spot price, and sigma F is the standard deviation in the changes of the futures price. I calculated these values from the data of just 1st June to 5th August, and I found all this out, and I found out that the optimal hedge ratio is 0.53, which means if you think that you want to hedge yourself for 250 tons, and 250 tons means 50 contracts. 50 contracts into 0.53 means you can just go for about 26 contracts, 26 or 27 contracts. So that is about the basics of hedging that I wanted to, that I could really discuss with you today. Now I want to ask you, maybe Bhupalini, is there anything else you want me to discuss?
Ma'am, I think you've covered all the aspects and the details about hedging, the position limits, the margins, everything in detail.
Everything has been
I
covered.
request, yeah, and I request the participants, if they have any queries, they can ask you. We have another 10 minutes to spare. Anybody, any query? Ma'am is here
Yeah, I'll be
from
there. Bhupalini,
academic.
also probably you could share my email ID if anyone
Yes,
is
yes, sure.
has a question they think of later. You could share this presentation also with them.
Yes, ma'am,
Okay,
sure. You
and
can
if
share the presentation with me and I'll share it with
I'll do
Kalpna
that.
so that they can
I'll
send it
do
to all
that.
the participants. Yeah, so I
Uh,
think from a conceptual perspective, if any of you have any queries, I request and ma'am is here. She'll be happy to solve your queries, or if there is any kind of clarity that you require on the concept, participants can post their questions either directly or individually through the chat box. You can
yeah,
ask your questions.
don't one is if you are not very confident about asking a question, you can ask me privately. Don't reply to everyone this time, but if you are clear on the concepts, then reply to everyone. So
Anything. I mean, how was the session? Was it did the session cover all the concepts that you were looking forward to, or anything that we missed out on so that we can cover in the next session? I would also like to tell all my participants here, like today is the first session. Next Saturday, we will also be meeting for a follow-up session, which will be taken by Mr. Sumit Gupta, McDonald Pells, and he will be covering more on the real-time case studies. And at the end of the third session, all the participants who attended all the three sessions would also be given a certificate on behalf of NCDX for this classroom series on price risk management.
may I scare them a little bit? I'm going to ask you some questions based on
Yes,
this
ma'am.
for
Yeah,
your
please,
certificate. So you better ask me, okay, all of you, if you are clear on this, or we'll ask them the question today. Shall I ask them today, or shall I ask them at the end when they have
ma'am,
questions?
on the third session, probably we can
Okay,
ask the
okay.
questions, the
So
assessment
if you have
questions.
any doubts, ask me now because there's going to be a small test for you. And if you have any doubts, then you are going to have a little bit of a problem. So any doubts, please ask me. If you've understood very well, very good.
Ma'am, I think you can share your presentation with me and I'll share it with them.
Yeah, that
And
I'll do.
yeah, if there are no questions, uh, if there is any kind of hesitation, ma'am has shared her email ID, or I'll just put it in the chat box for you
I'll
guys.
put it. I'll put it. Don't worry.
Yeah, you can ask your queries directly via mail also to ma'am. And I would like to thank Neeti ma'am for taking time out on this Saturday and actually, if, explaining all the concepts so clearly. It's been a very, interesting session for me as well, ma'am, to understand them, some of them,
Thank you.
some of the
Thank you.
concepts. And I hope the participants who attended also have taken, it's been a very positive session for them, and they've taken because most of the people who come to the derivative markets or to commodity markets, they think delivery is the main objective of these markets. But you stressed on the fact that delivery is not the aim of these markets. The price risk management and locking the price, which is more important. I think that concept has been stressed upon, and I hope to meet you all in the next session, wherein we'll be discussing more on the case studies related to hedging and price risk management. Thank you all for joining in on a Saturday for this session, and we hope to look forward to meeting you next Saturday and also receiving questions from you all. Thank you all.
Thank you, Bhupalini, for
Thank
conducting
you
the
so much,
session. And
ma'am. Thank you so much.
bye,
Yeah.
bye.
Thank you. Bye. Bye.